In this video, I'm going to show just a couple of investments that I've been buying more shares of over the past month. As we're now gearing up to see interest rate cuts, there's a handful of sectors and companies that I've been buying that should directly benefit from that. As of the making of this video, the majority of economists are now expecting the Feds to cut interest rates by a pretty small amount and likely won't be too aggressive. This is coming after news came out on Wednesday that core inflation still rose by 0.2% in August. So it now appears we won't likely see a dramatic cut this month, but I am still buying the following, with the first I've been buying more aggressively than most holdings in my portfolio, which is the Reeves Utility Income Trust, ticker UTG. This closed-end fund seeks to provide high monthly dividends and capital appreciation. UTG pursues this objective by investing at least 80% of its total assets in dividend-paying common stocks, preferred stocks, and debt instruments of companies within the utility sector. The fund will also invest in other essential infrastructure and related companies, and will also invest up to 20% in the securities of companies in other sectors. UTG currently offers a yield of over 7% and has never gone through a dividend cut in its more than 20-year history. They did have a consistent amount of dividend growth for a long time, but they've chosen to be more conservative as interest rates have gone up. As of June of this year, it holds about 60 different investments, which include a lot of big-name utility companies like CMS Energy Corp., PPL Corp., and CenterPoint Energy. But then it also holds other stocks like American Tower Corporation, which is a REIT that owns cell towers. It also holds T-Mobile and Comcast, who do own a lot of infrastructure, but aren't exactly like the other companies here. So you can see there's a mixture of utilities and some similar companies. UTG has been seeing some good growth in share price over the last few months thanks to the market being more optimistic about interest rate cuts. The utility sector in general has largely been beaten down ever since interest rates were first raised because these companies have very large infrastructure expenses. Power plants, cell towers, and water treatment facilities are very expensive to build, repair, and upgrade. And so these companies usually need to borrow large sums of money to do these things, and so when interest rates go up, then these companies have to pay more interest expense. It can also slow down growth for these companies, which also negatively impacts their share price. Now that it appears we're about to start getting interest rate cuts, these utility and infrastructure-heavy companies will experience better growth prospects and less interest expense. That should result in utility investments like UTG faring better in the market and hopefully go back to seeing dividend growth. The second holding I've been buying more shares of is Capital Southwest, ticker CSWC. They're a business development company that provides flexible capital solutions to help lower middle market businesses grow through acquisitions and capital investment. According to their website, they focus on thoughtful and timely responsiveness that balances preservation of capital and long-term shareholder returns with the needs of their portfolio company businesses. Capital Southwest is the oldest publicly traded BDC in the industry. The company was launched all the way back in 1964 and became a BDC in 1988. In 2015, they transformed their business in order to pursue a more income-focused investment portfolio. They spun off most of their existing investments into a new company, which is CSW Industrials, which were mostly equity investments that weren't yielding much. This freed Capital Southwest to pursue more higher-yielding investments, and the results have been excellent for them. Since 2016, when they started paying dividends quarterly instead of semi-annually like they used to, they provided a lot of special dividends and regular dividend increases. In the last 5 years, there were only 2 quarters where they didn't pay a special dividend. They did suffer a slight dividend cut during the pandemic, but it's since been fully restored and is now even higher. They also raised their regular dividend last month, which is something we haven't seen a whole lot of this year in the BDC space. BDCs in general were really aggressive in raising their dividends and paying a lot of special dividends in 2022 and 2023, but the majority of them have chosen to be more conservative this year with their increases. Some of them have been seeing increased pressure due to higher non-accruals, so that's another reason why a lot of them just haven't been growing their dividends this year. From a share price perspective, they've also had pretty good growth in this area as well. They perform pretty similarly to Main Street Capital in that regard. Although I did buy some more shares about a month ago, I didn't pick up too many because this stock is pretty significantly overvalued right now. I'm still getting a 10% yield for my money, but it's still near an all-time high. So I have been buying smaller amounts whenever I do invest more in CSWC. The next holding I've been buying pretty aggressively over the past month is PFFA, which is the InfraCap US Preferred Stock ETF. I won't go into too much detail about this because I just covered it last month, but this ETF seeks current income and secondarily capital appreciation through owning a portfolio of preferred securities. On its fact sheet, it lays out 3 key features, which are a focus on income, active management, and enhanced exposure through using a modest amount of leverage to help enhance portfolio beta and current income. Preferred stocks are a really great source of income, and their dividends are safer than common stocks. Although there's practically no growth with preferred stocks, they all offer high yields, and PFFA pays monthly dividends. It's much easier to buy an ETF of preferreds as opposed to buying them individually. They're usually thinly traded, and it's not ideal or even possible to build up a substantial position in some of them. PFFA offers a yield of almost 9%, and like I said, preferred stocks are a good consideration if you're a fan of a high-yielding investment that pays monthly. They can also be ideal if you're retired and need that consistent income. It does come with a high expense ratio, which I've seen people complain about, but it's largely due to the small amount of leverage that it uses. It's how this ETF yields so much more than any other preferred ETF out there, so it's something that I'm willing to put up with. But that's PFFA, not a growth holding unless you reinvest the dividends, but it is a steadier holding. Another stock I bought more of not too long ago was Triple N REIT, ticker NNN. Triple N invests primarily in high-quality retail properties that are subject generally to long-term net leases. The company was founded back in 1984, and they're one of only 3 REIT dividend aristocrats that exist. Today they currently have a market cap of almost $9 billion as well. Not too long ago, I was asked what makes Triple N an appealing investment to me and why do I keep buying it. It's true that it's not too exciting of an investment, and the dividend growth isn't exactly spectacular either. But the reason I keep buying it is because I sleep well at night owning it. It's very steady, and that's what this management team is going for. As of last quarter, their dividend payout ratio was a comfortable 69%, and they just increased their dividend 2 months ago. I also first bought into it when it was yielding much higher, back when REITs were still down from interest rate hikes. So I initially locked in with a yield of well over 5%, which is better than what I typically aim for with my growth holdings. I was also recently interested in picking up more shares of a REIT in my portfolio, and Triple N made the most sense to me. I'm still currently over-diversified in Realty Income, and another diversified REIT that I own, which is Agree Realty, has shot up so much in share price in the past couple months that I'm now waiting until it comes back down a bit. Triple N continues to be a really solid diversified REIT that holds a wider range of property types. They hold a lot of convenience stores, wholesale stores, car repair shops, and other similar types of properties. They have a 99.3% occupancy rating, and their leases are triple net, meaning that tenants are responsible for covering repairs and upgrades. That saves REITs like Triple N a lot of money that they can use for other purposes. One of those would include paying better dividends. They have a 34-year track record of consistent dividend increases, making it through the financial crisis and COVID among other difficult situations. And that's just what I've been buying recently over this last month. If you're interested in holding any of these stocks or investments for yourself, be sure to do your own research and come to your own conclusion as to if you think this would be a good fit in your portfolio. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.